candlesticks soften up when they make new highs. For example, the candlestick here is higher than the previous candle's high. Price is then up. Likewise, the candle here is higher than the previous candle. Price is then up. Likewise, here it closes higher than the previous candle. Then price up. There are several other places where the price is higher than the previous candle. For example, here, the price closes higher than the previous candle. The same here, same here, same here. When a candle closes higher than the previous high, it goes up after that. This is the pattern that appears in an uptrend. The same thing happens with volume. When the volume is higher than the previous volume, the price then up. For example, here, the volume is higher than the previous volume. The price then up, as you can see. Same here, closes higher than the previous volume. Then the price up. Here, too, it is higher than the previous volume. Thus, prices tend to up when they are higher than the previous volume. There are several other places where prices are higher than the previous volume. For example, here, the price is higher than the previous volume. Same here, it is higher than the previous volume. As for the difference between a candlestick and a volume, this candle is clearly higher than the previous high and higher than the previous volume. When this condition occurs, the stock price up. Of course, it can temporarily go down like this. This stock has such a characteristic of up over time. Now let's look at some other stocks. The next stock. Let's first look at this stock at its previous high. It is a candlestick. For example, here, it is higher than the previous high. The stock price is up. Here, too, it closes higher than the previous high. Then it took 9 business days for the stock to close above this high. It has been up since then. And the candlestick here closes above the previous high. It is like thus. Now let's look at the volume. For example, here, it closes higher than the previous volume. Then the price return. And here is where it closes. What I would like to mention here is that the colors are different. They are red and green. The green is more than the previous red is more than the previous green. Then the stock price is going down. Now green is more than the previous red, and the stock price is up. The red volume here is higher than the previous red volume. It is closes higher. And now we are in the green, and the green is more than the previous green. In this way, the amount of selling volume and the amount of buying volume in the green indicate whether the stock price is up or falling. For example, here we have a downtrend. All we have is selling volume. There is more selling. There is buying here. As you can see, there is a big buy in here. This is how a large buy is made and leads to the subsequent movement. Now let's look at another stock price. First, it closes above the candle's previous high. Then it's up a little and then falls. Here it closes above the previous high. The next day, the price up a little but then down. Here, it closes above the previous high. The next day it's up a little but then down. Here it closes above the previous high. The stock price has been up since then. It closes above the high as well. It is up. Above the previous high here. Then it is up. It's also higher than the previous high here. Then down for a day. Then up. It's up above the previous high. It's up above the previous high here as well. If you look at the volume, it is clear that the volume here is increasing. The price up is accompanied by an increase in volume. It's around here that there is a lot of volume here, where the buying volume is clearly increasing. Where there is a lot of buying volume, the stock price is up, or the stock price will up thereafter. In other words, the price up when the volume is clearly more and clearly more than the previous volume. And if the candlestick is making a higher price, then the price of the stock closes to go up after that. This part of the market, where volume is low, sometimes up, but it is not accompanied by a big, spectacular up. The price of a stock in this part of the market, where the volume is low, may up at times, but it is not accompanied by a large and conspicuous up, but rather a gradual up. Therefore, there are times when there is a gradual up in volume and then a sudden increase in volume. Therefore, a situation where volume slowly up and then volume suddenly increases is a good place to buy. When the volume increases and then up, the price will up sharply. That's what I mean. Next one. Let's look at it again from the current viewpoint. First, let's look at the candlestick. It closes above the previous high. Same here, it closes higher. It closes higher. It closes higher. Closes higher. Closes higher. And so it goes here. Closes high. Closes higher. Let's look at the volume. There's buying going on. Where the price is high, there are buyers. Naturally, there will be buying as a market up, but the easiest way to understand this is to take a look at the volume in the area where the market is up. When a price up sharply, volume always increases before the price up. Look here. Volume is low. It moves slowly, and then volume increases. It clearly increases. And after that, the stock price will make a big upward move. Next, let's look at the next one. Here, the volume is slowly increasing. After that, the stock price is up, but the stock price is falling. And then it moves slowly again. Here, it increases, and then the stock price up and then falls again. When the volume is accompanied by a large increase, the stock price will grow. It is the same here. When volume increases, the stock price will move upward. Therefore, it looks like a temporary drawdown here. But from this point of view, the price is clearly low. That's why the volume is slowly increasing. After that, buy it when the volume increases. Then the stock price will up in the medium to long term. When the volume increases, the stock price will up significantly. The volume is slowly increasing. Then one day it will increase. Then the price will up. And then it will increase again, slowly and steadily, as the volume slowly increases. Then the stock price up. Slowly and gradually, the volume increases. When the volume increases in this step, the stock price will up rapidly as well. Next one. Volume will slowly increase one day. Then the stock price up. Here, the stock price falls because the selling volume. The stock price falls because the selling volume is increasing. This is the result of many people pursuing short-term profits because they sold the volume they bought. And the volume is slowly and gradually. Volume will increase one day. Here is an opportunity. It's down here, but the buying volume is increasing, which means it's a buying opportunity. If you buy here, the volume will increase. If you buy here, the stock price will up. Then the stock price will up. If you buy here, the stock price will up. Then the stock price will up. Now, let's look at the last stock. The volume will increase slowly and gradually, and then one day, the volume will increase suddenly. The stock price up sharply. However, the volume does not exceed this volume. Therefore, the stock price falls. The stock price will slowly and steadily build up volume again, and then the volume will increase. Then the stock price will up. That is why the volume will increase one day. A sudden increase in volume is a sign that the stock price will up. The same is true here. When the volume increases slowly and gradually, the stock price will move up. Therefore, by watching the renewal of volume as well as the renewal of high price of candlestick, we can see whether the stock price will go up or not. Thank you.